Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Monday, June 13th, 2022. What I'll do is cover the usual suspects, the ones I've been highlighting recently, which are the equity markets, gold and silver, the precious metals. Definitely want to do an update on Bitcoin and crypto. And then what's been my favorite short sector, and that is the energy stocks, including oil and gas as well as coal. So we'll start out here with the markets. This is QQQ. Remember, keep in mind this is Fed week. We have on Wednesday at 2 p.m. the FOMC announcement. We already know we're getting a hike. We already know it's going to be 0.5%. That's pretty much baked into the cake, and it's more so about what Powell says afterwards and how the market takes that. So let's talk about the charts. Here we're at we've undercut the recent lows right now, and technically that does open the door to the next target down there, 268.30, and or that yellow trend line. Now again, I said it last week, take everything that happens this week with a grain of salt, because you do have the FOMC meeting on deck, and you tend to get volatility leading up to that and afterwards. But as of now, they took out the lows, and there's no way to spin that as anything but bearish. Remember, we also did that recently back here. This was our previous low right there, and then we undercut it ever so slightly, a marginal new low, which was also a divergent low, and that proved to be a bear trap, i.e. false breakdown. You recovered it, and we had one more run at it, but we put in a higher low, and then we rallied up and then hit that third target zone, which was also the third target zone I gave you on NQ, which was actually on the NQ chart, 60-minute chart. That was the final target zone listed, although I thought we might be able to carry up here, get one more thrust higher. That never happened. So that T3 zone was also in the middle of it. It's called a support zone, or resistance zone, I'm sorry, when you have two price levels in close proximity, and smack in the middle of that, again, it's highlighted, you had the 38.2 Fibonacci retracement, which is a typical retracement in a any trend, and that's what we got there. So here's where we're at. This morning we were testing the lows, but we've undercut those lows, so now we have pretty much no support, at least not this year. That's a new 52-week low. It should be, or at least a low for the bear market. Yeah, if not a 52-week low, but a low for the bear market. And again, took out a major reaction low. So as of now, we're actually having those double flags. Yeah, I told you I've seen them play out. It's not common, but I'm referring to on the futures. And right here, you had that impulsive move down, little flagging action. Played out almost perfectly there, and then another flag, which is now once again played out. Pretty much the flagpole is the impulsive move down leading up to the flag. So we have double flags, and they've both played out to their full extent, and that's on the futures. On QQQ, it looks a little bit different. Let me show you that real quick. QQQ on the 60-minute chart, remember, we had a flag on the pre-market session, but not in the regular session. So if you take the flag on the regular session, you can, this is what I gave you on Friday. I said measured from that point down is the flagpole, and you put that to the highest part of the flag before it breaks down, and that would project down to about 272 or so. And you can also do it from this point here. That's really where you started falling impulsively, because there was a little consolidation first. And so let me put that there and give you a measurement on that. There's the flagpole. Take that, add it to the highest point of the flag, that little high of that candle there, and you're getting close. You're down to about 274. And again, let's reconcile that. So 268.30. Again, I maintain what I said before. The risk reward is there's not a lot of downside to the next targets hit from where we're at right now, maybe 3.5 to 6%. But let me tell you what concerns me a little bit, and why we could blast on through there and go on down, hit my final target. Final target remains those what I call pre-COVID highs, where we were back in February 2020 before COVID took hold of the markets, and that's going to give you a move down to about 235. It's covered by this alternate. I have two trend lines here, 235 and the blue trend line right there. Okay, what could cause that is just a complete snapping in the markets. Why? Okay, I talked about this quite a bit back here, and for several months, I've talked about the what makes this time different. A couple months back, I even was I've had quite a few Fed rants, and you've carefully selected my words, and I said Powell, in my opinion, and the Fed is certainly grossly negligent, and in fact, and I've used the definition, may possibly even criminally negligent in their behavior, in both of their actions and more so inactions. And again, what I'm referring to is, when COVID hit, you can say what you want. I think they did too much, both with DC as well as the Fed, fiscal and monetary stimulus, but it was more of the inaction afterwards where you could see, as I've gone over time and time again, showing you very simple to track, much more accurate measure of inflation than this darn CPI. And I know the Fed uses an alternative measure of inflation other than CPI, but that's the one everyone else tracks. And it's simple. It's just commodity, broad-based commodity ETFs, and then when you drill down within the broad-based commodity ETFs, you can look at each and every component of that. Gas, crude oil, natural gas, and all the different agricultural commodities, industrial metals, and all that. And so it was very clear and very apparent. And then you couple that with the housing market; those trends are also easy to track. And so again, here's somebody that's supposed to be considered the most powerful position in the world, running the the Federal Reserve, central bank in the world's most powerful economy. A lot of people consider Powell, more powerful than the president, and I think that's safe to say. And so again, to not pivot until only recently this year start raising rates, to me, is because of the impact it's going to have on a lot of people's lives, and that's where again, it was something that was it's not Monday morning quarterback to say, oh, the Fed waited too long. It was obvious, and again, I wasn't the only critic all along. So anyways, so now that what's happening is happening, and again, it was priced in the charts. But let me show you what my concern is here. I've talked about this quite a bit. So you have, a lot of the money, tremendous amounts of money in the stock market. Besides your 401k and your IRAs and your savings, you have pension funds, pension plans, and tremendous amount of money in those, and very important in the economy. And they've been, as I've talked about for quite a bit time now, they've been overweighted equities, trying to play a game of catch up because they've been grossly underfunded for a long time now. And now, and again, I've talked about this in the leading months, is the old 80-20 rule, asset allocation model. Back in the day, and ever from the gold standard for a portfolio was the 80-20 rule. And that number can vary. You could have the 60-40 rule for more conservative pension funds. And what I'm referring to is the asset allocation model. Let's say a more conservative model would be 60-40, 60% stocks, 40% bonds. And because of historically, and you can go back as far as the modern financial markets go back, and you will see that normally when stocks fall, bonds go up, and so that bond portion cushions the drop in the stock portion. But again, and this is where the Fed, what they've done, and by being what I refer to what they've done, and it precedes Powell, goes back to the financial crisis. No, it really goes back to after the tech bubble, but where we started an era of artificially low rates, but primarily back in the housing crisis in 2008 when they first started the first zero interest rate policy and quantitative easing, and then they kept it, rates at the floor even though the economy recovered, and so they kept rates too low too long. And the big worry here is you have stocks falling. So we know pension funds and the likes are getting hit hard. But you also have Treasury bonds falling, and I've been adamant for the last couple of years that Treasury bonds had nowhere to go but down, other than tradable rallies. This is when they took rates to zero. Remember, this is interest rates going, bond prices go up when rates go down, and that was the floor. So we knew at best case scenario, this is what I've been saying for a couple of years now, at absolute best case scenario, you would make next to nothing on your bonds. Your bond prices would remain stable. Interest rates, the Fed would keep well, again, they don't control long-term rates, and that's where they were playing a dangerous game here. But the markets would keep rates at near zero, very low, and you'd collect your paltry little percent or so on long-term bonds and not lose anything. But the reality is when interest rates go up, bond prices go down. So of course, as I said, there was nowhere at this point for rates to go but either stay where they were at, or bond prices stay where they were at, or drop as rates go up, and they've dropped. So this is what is unusual. Since 2020, you have bond prices, one of the biggest drops that they've made in really in history. Obviously, we're coming off a secular bull market in bond prices, which is a bear market in rates. I've talked about that. But so far, the drop has been very big. And so this drop is coinciding with a drop in the stock market. And pretty much everything except energy, and I'll get to that in a second, has been falling. That's the only sector that's held up, and that's also why I've shifted my focus now and think that's the most meat on the bone as far as sectors go for downside potential. So again, where the markets, have a little more downside to go, when you look at SPY, if we come on down here to my longer term target, 354.13. There's your pre-COVID highs coming in with about T2, but I'm watching QQQ as well. We'll reconcile those. Let me just say before I get off this, the equity markets, and move on to the next stuff, that we are right now once again making so far at this point in time a marginal new low. So here's the 60-minute chart of the S&P 500. There was your last low. It was a divergent low. We had that first leg up, correction. I thought we might get a second leg up, and at this point, you want to call it, we took out the low, so let's just say that scenario is, let me try to be clear. It's not off the table because this is a marginal new low. If we can rally up here, and depending on what the Fed does. Right now, we're in a precarious position. Make no mistake about that. So the thing about these little whipsaw moves, like the lows that we had back here when we took out that previous low and the markets rallied, it's very simple if you're going to trade it. You don't go long on a breakdown of support. Absolutely not. If anything, you close out longs, you get short if you're not short, or you add to shorts. That's a breakdown. Sell signal. It's very simple, and it comes on the heels of that. There's that flag as well in the S&P 500. I'm on a 60-minute chart. So we're getting down to where it's at. What you do is, if you think that's going to be the scenario and we're going to have another rally up, because there's still some divergences in place, there's still extreme overbought conditions, but those are also signatures. Bear market, those don't always play out. But if you think it happens, it's very simple. You just wait until it does. Wait until it actually happens. What I mean by that is a solid recovery back above the level, and then you have the makings for a bear trap, i.e. false breakdown. So, and it's not that much. You don't wait that much. It's only, only take us a couple percentage points to get in there. So we'll see if it happens again. Like I said, I don't have strong convictions right now on the markets, and nor do I think the risk reward is very favorable. Even though we have these sell signals, it's just the next targets, next support are not that too far below. The only concern, or one thing that may happen here, is, like I said, if the system breaks, if you get a whiff, the markets are going to reflect it first before you read about it, and there might be a reaction if a big fund blows up. Some kind of pension funds, they'll be, before this whole thing's over, trust me, you're going to hear rumblings of the government bailouts for pension funds. I'm sure it's coming, but that's going to be a little ways away. That'll be in the headlines maybe, I don't know, 6 months from now, maybe a little sooner. I don't know. It depends on how fast this bear market plays out. And remember, we're still not to my final target, so it's just a matter of, all right, are we going to go down this week, or will the markets kind of stabilize, chop around in front of the Fed? Right now, they're throwing a hissy fit. They're sending a message, like they did in 2018, to Powell and the Fed, that, hey, we don't like this. We don't like you hiking rates, taking away the juice. Where we want more of that. And they're not going to get it, and of course they're not liking the trajectory of these rate hikes. All right, so let's get away from that. You have the levels. We have the breakdown here. If you look at the daily charts, I want to just show you this before I get off here. So remember, we had, at this point in time on the daily charts, we had positive divergence Remember, we had these right there, bullish falling wedges on both QQQ and SPY, and we had breakouts, and we had a good rally. It was a nice bear market rally, and it was just that. And I said at the time it was just a bear market rally, but it was very profitable to trade, or very profitable to sidestep if you were short. In other words, close out shorts and get out, let the bounce run its course, and then reshort. And then we put in most recently a small divergent low. We still had the RSI divergent right here, and we did. We had another nice tradable bear market rally. We got in that little trading range, and then we broke down below the trading range, and it's been impulsive. This looks to me like that margin type selling, forced liquidation, panic selling, and that's nothing but bearish. Look at those three big candles, three big gaps down. That's more impulsive than pretty much any point we've had here. So this could be that big, wave count. Really, I'm not an Elliottian. Those are people that study Elliott wave theory, but you get that primary third wave down and a major trend. A primary third wave, it could be up in a bull trend, but P3 down out of a 5 wave is the most impulsive, and this is how they usually kick off. So let me just be very clear that even though I have outlined support levels below, we could be in that point, especially for what I'm seeing. Everything is going down today and has been for the last few days. I'm going to get to Bitcoin in a second. I think for long-term investors and hedge funds and pension funds that have gambled in a worthless security like Bitcoin, I think this is a lesson. We knew this would happen. Those that really didn't believe in Bitcoin, and now you're seeing that it's just outright crashing today, and it's been in a bear market. I'll get to that 1 second here. Okay, before I do, impulsive or not, and that's what we have. 3 big red candles on gaps down, and it was a breakdown of this area here, which did indeed. Gosh, we keep seeing these, talk about these trading ranges, building energy like a coiled spring, and the break was to the downside, and there was no recovery. In fact, it hasn't looked back since breaking down there, and that's what Bitcoin just did today. I'm going to get to that in 1 second. Okay, so that is the bad, or the ugly, and again, there's no way to spin this as anything but bearish. Everything's happened the last few days. Here's some potential divergence right here. So I'm going to give you the good, bad, and ugly. We did have that divergent low there, and it gave you that rally, but then we broke down from the trading range, and we're selling off here. Now, again, depending on what happens soon, here's a divergence line. It is what I call potential divergence. It is unconfirmed. These are momentum indicators, and they are clearly right now, the PPO and the RSI, pointing lower. And I always say this is the big difference between confirmed and unconfirmed divergence. We just made a bearish crossover, so I'm giving you the good and the bad here. That's bad. We made a rejection at that red line I have, which does a great job, or has recently, at finding bull and bear trends. When this white line, the 9 EMA, is above the red line there, trend is bullish, and when you cross below, the trend is bearish. And that line also, once you're above it or below it, acts as support or resistance. So you had a rejection there, kept the trend bearish, and then boom, crossover, and then it went bearish again, and it remains bearish. So that's the bad. The crossover is bad in itself. Now, if we can, at any point, as long as this divergence line remains intact, it's a moving thing. But if it moves down here, or if we turned here, we would have positive divergence. To get rid of the divergence, we have to take out, in both the RSI right here, you have to take out the previous lows to negate that. So the first step would be a takeout of this low on the RSI, and then the PPO, you really have to come all the way down here and take out these lows. So that's one thing to note there. And then on QQQ, same thing. We can extend the divergence. That was a divergent low. It did give us a rally, just like that divergent low. And just like SPY, we have potential divergence still in place, but it's a matter of how far are we going to go. And that's the thing. We may hit down here and hit this third target, and then have that divergence on the daily, and that'll set up the next rally. So here's where I'm at. I'm looking right now. Certainly makes sense to be short now. I've taken whatever I had a small long position coming in today, saw what was going on, flipped out of that short. I'm going to hold on to that short unless the markets tell me that they want to do that little whipsaw bear trap reversal, and then I'll consider either getting out of that short or going back long. But as of now, I think the odds favor we continue on down to the next support levels because we've broken support. And then on IWM, we're back to that former second target. IWM, these targets were laid out way back here. Hit the first target, bounce, set up that trading range, hit the second target, bounce, set up this trading range, and we're back to support there in the small caps. So, but remember, we've already had the initial reaction. We hit that level for 3 consecutive weeks, bounce back to the top, as well as a trend line. So, the technicals are playing out very well. And if we break this, a solid breakdown, that's going to take us to that potential third target. Now, if QQQ and SPY continue lower, that's almost certainly going to be a third target, not just potential. As of now, you have to recognize we're at support on the small caps as well. And actually, there it is. We're testing the recent lows right there. And you still have strong positive divergence. So, all right, that's a lot of talking about the indexes, but my takeaway is, like I said, the risk reward to me, and this is where it's just emphatic, is back here, and the breakdowns here, and the back tests. These were all the levels I got excited and would press hard. Then we broke down the bottom of the range. There was a breakdown. There was a back test to it. These were all your objective short levels right now. As you get very oversold, and especially with divergences, it just becomes less and less. Now, I like to pick on the, or focus on sectors. This is where I think it's, kind of roll away from that easy money on trading the indexes that we've had for pretty much all year. That was my primary focus on trading, highlighting objective short entries on the small caps and the Nasdaq 100. And at this point in time, it becomes more of a sector thing to me. You have XLK, the tech sector ETF, also still coming up on support. Remember, this is the Nasdaq 100 for all intents and purposes. You had the wedge right there. You had up there, divergent low, breakout. There was that first rally. We just had this second rally. And this is a support zone. So here's tech still at support. You can't write it off yet. Again, beat down. And as I told you recently in this rally, that's where I'm most bullish on right now. So I'll be very clear. If you want to trade a hedged portfolio right now, I would be long tech, short energy. Okay, energy is my most bearish. Tech is my most bullish sector. Now, I'm talking relatively speaking. In other words, that's what trading is all about. You want to outperform, and I think on the downside, I think energy will outperform tech. So in other words, in a broad-based sell-off, everything's going to fall. All 12 sectors, or all 11 sectors, in the S&P will likely be down in a broad-based sell-off. But at this point in time, I think the potential for a snapback is much higher. You can see the divergence is building. We had divergence on this recent rally in the tech sector. We had that consolidation. We broke to the downside, and now we still have divergence here as I extend the line right there. Okay, so that's it. There's tech. We go through the rest of the sectors. I will say today, and this is one thing that got me to flip, but I may cover that short because I think the downside's limited. But a breakdown, we had a gap down in XLV. This was a big level I've been watching in the healthcare sector. And so this is just another sector now that has been taken out, boom, and shot. So there's a check mark, a breakdown in XLV, the healthcare sector, one of the defensive sectors, a sector that's been holding up. And I'm talking about a break below that trading range here. You had these two whipsaw false breakout highs and now a downside break there. So that's obviously bearish for the overall markets. XLF, well, as I'm doing the video, I was going to update it. We've effectively now hit my third target here. So I'm going to mark that hit close enough. Probably continue lower. So by the time you get the video, it will probably be a full hit of that level. That's about 31.35, but I always say cover a little bit above. And it's been a slow roll. This is where I started calling for major top on the financials, and I talked about it quite a bit. We went up, made two marginal new highs. They were still divergent highs, and they were still within levels where if you're targeting T3 or more, then it should not have triggered any reasonable stop. And so now we went on, set up in that trading range, actually right there. That was my box. Broke down below and recently had a back test. Broke down, hit my second target for a few weeks, traded on it for about a week or more. Went up, back tested the bottom of the range. That's this orange colored box right here, the shaded box, and boom. So here's a sector now at support, a key sector right there in that 3T. So there's a chance for a bounce here. All right, in fact, because of that, I just paused the video. I just reversed. That's just me. I'm seeing this. I'm seeing XLK, and I reversed to a long, cover those short positions from this morning. And for small gains, again, I'm in more, and for the markets, I'm in active trading mode, but I'm going to get to where I'm swinging right now. That is XLF at support, third target hit, so reaction likely. Maybe even a little more downside, maybe not. There's XLC, communication sector ETF, now, which is one of the 11 sectors of the S&P 500 as I'm going through. But this is really just Facebook and Alphabet. And it's back testing. You had a nice bullish falling wedge here. Complete right there with divergence on the RSI down here. Yeah, a little bit of divergence at the end there on the PPO. And it's basically a breakout and a back test. So there's a chance here, guys, that we could still rally up and hit those next targets there. Who knows what the Fed's going to do or say, but I think whether they say it or not, I think the interpretation is going to be the stock market's doing a lot of their work for them. By cooling down consumer sentiment, spending, nothing, and I mean nothing, is going to put the brakes on consumer spending and inflation like a drop. The headlines this morning before the market even opened up, the S&P entering bear market territory because it was poised to gap down. And you know, if it closes where it is right now, then that is going to be, I believe, a 20% drop off the high. I told you, to me, that's an antiquated the definition, because 20% to me is just correction, really. But it doesn't matter, because I try to get in my head what the masses are thinking. And remember, the masses, and I'm talking John Q. Public, they tend to want to buy at the absolute worst time. They chase the highs. They buy at the highs on FOMO, fear of missing out, and then they panic out. So we could see a near-term selling climax and you know, drift up into and maybe after the Fed meeting. So there it is again. And like I said, if you want to, you know, I'm showing you sectors that you might want to over or underweight if that's where you're going. And I think you'll do better off going long the most bullish sectors and or short the most bearish sectors right now, and or other instruments such as commodities, which I'm going to get to in a minute, than you will by trying to trade the broad markets right now. XLI, industrials. I'm just rifling through all the sectors of the S&P. Oh, that one was worth mentioning. XLP, look at that beautiful, yeah, the trend line right there, the primary uptrend line, that yellow line, breakdown, back test. So, I mean, there's a lot of evidence here that this bear market's still just getting underway, and that was just a bear market rally. And, you know, XLP, there's a sector I have no desire to go long that ETF or those companies in there until you get down to this next target here. So, like I said, I can make a case for more down. I know we're going lower. I feel pretty confident, I should say. I shouldn't say I know. In the coming weeks to months, it's just a matter of how do we get there. We're going to bounce first, and like I said, and remember, as I go down the line, what I'm doing right now, I'm going through the 11 sectors in the S&P 500. I didn't mean to move that line. I was trying to grab this. They are, I go through those when I cover the S&P 500 sectors. I go through them weighting as the market weights in the index. So as I get down the line here, XLP, consumer staples, which is a defensive sector, last time I checked was less than 8% of the weighting in the S&P 500, where you have about over a 25% weighting in tech, or you did recently. I don't know, with the tech wreck, that might, I'm sure that took it down maybe under 25. All right, next up, and I'm not going to do them all here, there's XLE, okay? And so I told you last week and the week before, this is where I've started to engage on the short side, and I think there's the most meat for the bone. But I have to mention, this is where I'm segueing into this, we are at support. We are at trendline support right now. To me, it's a matter of more of when that breaks and if. But you're at trendline support, and there's another support level there as well, which is, you don't see it now, you will in a second here. It's the 50-day exponential moving average. Does a pretty good job of, here, let me give you another board, a clean board. There you go. You can see the 50-day moving average acting as support, 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 support. Support once broken becomes resistance, right? And then resistance, 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 resistance. Well, we took it out. Great. All right. So you're above it. So you want to look at it here. You kind of did a little moving through it. You did some sideways trading, but finally you recovered it. And then support, 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 support. Boom. We're coming down to that. Okay. So that coupled with the uptrend line. If you took it, it's down another 6% today. Remember, we broke down last Thursday, followed through, solid confirming candle on Friday, and you're down 6% right now at trend line and 50-day moving average. Also, I told you in this order, so XLP is down 6%. I said the next one, you'll get more juice going with XOP, the oil and gas exploration production sector, and that is down likewise 7.36% right now. Also kissed support today, so there's your chance. You get a quick 10% if you took the drip that I gave you, which is 2-time leverage, same sector. You made over 20%. And then I said you'd get the most bang for your buck shorting XES, which is down 7.7. So even more. The XES tends to fall. So they're in that order. And again, as I said, you're either going to get the call in the energy sector right or wrong. If you're going to get it right, you're going to get more juice trading XES. You're going to get a little less juice trading XOP, and you'll get the least amount of juice trading XLE. Okay, finally, and then I said, the best bang for your buck will be in the coal sector, and these are all my picks here. Arch Coal down 9%, and all bouncing right now because the energy sector just hit support. HNRG down 5%, 8% down on AMR, and 8.5%, and all nice. These are the ones, again, I said take these tactically, wait for each one to break down, and that's what happened. This one broke down. CIX down another 8.5% today. Remember, AMR broke down last week, following through today. CEIX, BTU, forming that head and shoulders topping pattern potentially. METC down 10.5%. NRP down 10.3. Beautiful. Look at that. If you took the short on Friday, then you're down now 10.3%. So again, most bang for your buck there. But you have to, unfortunately, there's, to the best of my knowledge, no more ETFs. There used to be KOL, and I think they retired that one. So again, I've said this before. Maybe you guys did comment and I didn't see it. If you know of a coal sector ETF, let me know, but I don't believe there's one. So you got to do the individual ones. I'll get to Bitcoin next, but just an update on crude futures. This is an hourly chart. We still put in that divergent high, but we've got a little bit of positive divergence. And remember, crude and nat gas have been resilient. You're seeing the stocks roll over, and that's the thing. A lot of people get tied up. They can't understand why the energy stocks are down so much. That's because it's a broad-based sell-off today, and that's where you're going to get, if you don't want to do a pure play on the commodities until they're absolutely, a knife through the heart in a downtrend. I'm talking about crude and natural gas. Trade the individual stocks. They're going to go down, or they have been with the stock market. But again, I just covered, my market shorts. Think there's a good chance we'll bounce here for the reasons I just showed you a minute ago. And if crude does bounce, here's your level here, 120.29. That's resistance where you could get a short entry. It's really good resistance if we get up there right now on CL crude futures. And then nat gas, this is a hourly chart. We'll kick it back to a couple months here. Just look for these divergent highs. They're not all marked. I had to replicate these charts when I got back from my son's orientation last week. I had a problem and I had to replicate all my charts on this charting platform. But there it is, these little divergent highs. And now we're starting to stair step lower a little bit here. Little divergent high recently right there as well. And I've already given you, it's really the big picture for nat gas. As I said, you're just going to have to be patient if you're trying to swing trade natural gas. Oh, my lines went away on this one. Let's see if I have it here. Yeah, there it is. All right, so that's the bigger picture on natural gas. You know, this big divergent high right here, negative divergence, wedge type pattern, um, and just need to break this level right here. That's where the floodgates open, I believe, a break of 812, and it would be also be a break below the uptrend line there, and then that's still my target right there. So a little work to be done there. And last but not least, Bitcoin. You know what? I'll get to Bitcoin last. Gold, I just wanted to say gold's kind of hanging in there by the skin of its teeth. You can see right here. This is gold futures 1, 2, 3. We had and recently a divergent low. We still do. I still like gold right there. There's positive divergence we had at this recent low. It rallied us up to the top of this trading range right here. Remember, this is the box we're in right now, and we're down towards the bottom. We've had now 1, 2, 3 tests of this low, and we still have divergence. So, money's going to have to find something. This is again kind of the theme I had before. I'm seeing everything was down today, and if that persists, that's not good. That's where things break. Hedge funds blow up. Individual investors blow up. They're most when I speak, I'm generically speaking, most individual investors are bullish and long. Most retail institutional investors are always bullish and long. Those are the facts. That's how it works. And so stands to reason when almost everything is down, you're going to see, even for a diversified investor like pension funds and institutional investors, when everything falls, crude oil and natural gas and gold and silver and platinum and palladium and stocks and all sectors, that's where things can blow up. So just watch that. That's all I'm saying. Right now we're at support here. I showed you support on the indexes. But if everything else starts to break down, that's where you could have the markets break. We have not had any type of waterfall selling yet in the market, or what I consider waterfall selling. Last few days, if you count Thursday and Friday, close to that. But again, I think, like I said, I think it's worth a shot to just like I said, I'm an active trader, and I'm just talking on the NQ futures, what I did here. But let me just show you Bitcoin. Bitcoin, if there's no other reason to trade futures, and again, I don't work for the exchanges. I don't have any vested interest. And there is, a lot to know about futures, and usually you have to have a larger account size to trade them. There are mini and micro contracts I talk about all the time. MBT being the micro or mini Bitcoin futures. This is just the big contract here, BRR. And so here's what happened. Here's that trading range that I've been highlighting recently and showed you even on Friday's video that, look, we're going to break it one way or another. Upside break is bullish, downside break is bearish. So this builds, it's like energy building, like a coiled spring. And so what happened? You had the downtrend line that was being tested there, test. And that got taken out, and most importantly, bottom of the range. Now here's where I'm going with this. This happened last night. I saw this breakdown was at about 6% gap down from where Bitcoin futures closed. Let me zoom in nice and tight. So, and that wasn't even like close. When something breaks down like this, if I was long Bitcoin, I'd give it maybe a little room to avoid, allow for these what I call whipsaws right there, because they're normal. That is a solid and clear breakdown. When that gap down, that was it. If you did not have a stop loss order in place, which is one of the benefits of futures, you can have stop loss orders that will go 3 in the morning. If that's when the breakdown occurs, you're going to get stopped out. Or if your price targets hit, it's going to fill you. And so you were able to last night, if long Bitcoin, take a hit of about 6%, because that was a 110% solid sell signal breakdown. And then you can see from there, after that 6% drop, Bitcoin didn't look back. That was, again, powerful energy building there, very well-defined trading range, and the drop so far has been about 22.5% from where we closed Friday, about 22%. All right, so remember, 6% was a gap down, plenty of time to exit, even afterwards. They didn't buy the gap up, it just kept dropping. And now let's look at Bitcoin Trust, GBTC, which is if you only trade ETFs, that's what you would have been trading, or something along those lines. There's one other one out there. The gap down on that, instead of being 6% from where we closed Friday to where we opened today, was about 19 to 20%. Okay, and so this is what I talk about all the time. Even the best place stop loss order, just below the range right here at 17,993, gets bypassed. And you have two type of orders. You have stop loss or stop limit. A stop loss order says, if my price is crossed, let's say it's 1780, whatever, sell me out, and a stop loss order will convert to a market order once that stop price has been triggered. So on a gap down, it converts to market order here, and it gets in line with all the other orders, and that's where you're filled. Now you can say, okay, that's too risky. I'll do a stop limit order that says sell me out if it crosses down to 1780 or whatever your number is, but only sell me at 1780. So what happens? Your stop gets triggered on the stop limit order, and you have a limit order to sell at a price of 1780 or better. That's what a limit order says to do. 1780 or better, nothing less, but then it remains open and will only be filled if the stock were now to climb back up to 1780. And so that's where there's no way to effectively hedge against an oversized big loss on a gap there on a ETF or any instrument that trades during the regular session like this one, 9:30 to 4 p.m. Whereas the futures, again, you had control last night. It was early Sunday evening when the futures opened up, and if you didn't have a stop loss order in place already, you could have manually got out of that. All right, long video. I'm wrap it up here. So, like I said, this is it. Expect some pre and post Fed volatility. And again, right now, markets are looking ugly unless something happens. And don't go by what I say. I reverse, and by the time this video is over, I may reverse back to short again. I don't really like what I see. I just saw a few sectors and things hit support there. In the very least, I'm going to end this video and go put tight stop loss orders that really probably take me out of break even on those longs I reverse to. So for a bigger picture perspective, I'm still overall longer term bearish to equity markets, just near term, and even near term bearish unless something big happens. We have to have a recovery today back above that level for me to even consider adding to or taking anything remotely close to a substantial position in the equity markets right now. At this point in time, I think the best trade to make is a somewhat of a hedged play on the equities, long tech and or the NASDAQ 100, which is mostly tech, against a short on the equity sector. And again, I may remove those long hedges here shortly and just be on pure play short to the downside. Maybe even get back in the indexes short. Like I said, I'm just feel like at this point it's picking up nickels in front of a steamroller unless the market breaks. And that's where I'm going to watch gold. I'm going to watch Treasury bonds, which are down, and all that stuff is no bueno for institutional and individual investors, because it could start a vicious cycle of margin call selling, and then you can get a big mini crash type scenario, which again, this has been impulsive selling the last few days, but you guys will know a crash when you see it. And this isn't it. We have not had circuit breakers kick in or anything like that yet. So if we get to that point, well, that's the time you want to be short if you can get into the shorts. If you wait too long and the circuit breakers kick in, yeah, they can. You can only short. They kick in the uptick rule and all that good stuff. But all right, I got to wrap the video up here. It's getting long. This has been Randy Finney with Right Side of the Chart. Have a good day.